Every time you swipe your card, take out a loan, or pay your mortgage, money is being created. Not printed, created. And here's the part almost nobody is taught. Most of the money in your bank account didn't come from a government printing press. It came into existence the moment someone signed a loan agreement. If that's true, then who really controls the money? And what happens when that machine stops? Most people believe governments print all the money we use. It's simple, it's logical, and it's only part of the story. Behind every paycheck, every home loan, every business expansion, and every recession, there's a hidden system that quietly creates and destroys money every single day. By the end of this video, you'll understand why debt powers the modern economy, why banks are far more powerful than most people realize, and why understanding this system could completely change the way you think about wealth. Because once you see it, you can't unsee it. The illusion. Take a look inside your wallet. You probably have very little cash. Most of your money exists as numbers on a screen. Your salary, your savings, your investments, just digital entries. Now ask yourself, where did those numbers actually come from? Most people picture giant printing presses running day and night, stacks of fresh bills. But in countries like the United States, physical cash makes up only a tiny fraction of the total money supply.
The overwhelming majority exists only inside computers, which raises an uncomfortable question. Who creates those numbers? Hundreds of years ago, money was different. Gold, silver, coins. If a king wanted more money, he needed more precious metals. Economic growth was limited by physical resources. Then banks discovered something fascinating. Most people didn't withdraw all their gold at the same time, so banks began lending some of it to other people. The system worked, until banks realized something even bigger. They didn't always need the actual gold. They only needed trust. That single realization changed history forever. Imagine you walk into a bank. You ask for a $300,000 mortgage. You expect the bank to hand you money from someone else's savings account. But that's not what usually happens. Instead, the bank approves the loan. A few seconds later, your account suddenly shows an extra $300,000. The seller receives payment. A new house is purchased. Everyone celebrates. But something extraordinary just happened. That money didn't move. It was created. At the exact moment the loan was issued, the loan became your debt, and simultaneously became brand new money circulating through the economy. This sounds unbelievable, yet this is how modern banking works in many countries.
So here's the real question. If loans create money, what happens when everyone stops borrowing? Think about almost every major purchase. Homes, cars, businesses, factories, college education, credit cards. Debt finances nearly all of it. Each new loan injects more money into the economy. Businesses hire more workers, consumers spend more, asset prices rise. Everything appears healthy until confidence disappears. Because the same machine that creates money can also make it disappear. In 2008, confidence collapsed. Banks stopped lending, families stopped borrowing, businesses froze investments. Millions suddenly discovered something terrifying. When fewer loans are created, less new money enters the economy. At the same time, existing loans continue being repaid, and every repayment quietly destroys money. Not physically, digitally. The money simply
Disappears from circulation. The economy begins shrinking. Companies earn less. People lose jobs. More fear spreads. Even fewer loans are issued. A vicious cycle begins. But if the system depends on debt,
Can it ever stop growing? You've probably noticed something. A burger that cost $5 years ago now costs 10. A house that once seemed affordable feels impossible. Many blame greedy companies. Others blame governments. Reality is more complicated. When the amount of money grows faster than the amount of goods and services, prices usually rise. That's inflation. Central banks try to control it by raising interest rates. Higher rates make borrowing more expensive. People borrow less. Money creation slows. Inflation cools. But there's a trade-off. Businesses slow down. Hiring weakens. Economic growth fades. It's a constant balancing act. Too much money, prices explode. Too little, the economy stalls. And someone has to make that decision. Most people think banks simply store money. In reality, they're deeply connected to the creation of it. Every lending decision shapes the economy.